So I remind people that every year we lose banks out of the U.S. banking system. So, since the Dodd-Frank legislation after '08, we've lost over 10% in the banks of the United States. So we've had this slow grinding, whittling away of banks in the United States. I think we're more acutely aware of what's going on now because we've seen larger banks, much larger banks, run into financial trouble, and we've seen larger banks go out of business. I don't think we have seen the end of this banking situation. I won't call it a crisis because I don't feel like we're in a crisis, but we're in a situation where banks were sort of flooded with deposits during COVID, flooded with deposits during the crisis. A lot of it was government stimulation. A lot of it was people just had money coming in. There was no way for people to spend money because there was no consumptive ability except for things that could be delivered to your house or you could buy at the grocery store. So your ability to consume money was fairly low, which meant there was no loan demand for banks. So banks were seeing deposits come in on one side and they were seeing nothing going out on the asset side. They weren't able to lend money to people because people didn't need to borrow money. So all of a sudden they were in this position where they had huge excess reserves. And the natural thing to do was to go out and buy some interest-bearing, low-risk asset. The most unique low-risk asset in the United States is a U.S. Treasury. Then we saw this massive move in interest rates, close to 500 basis points. So it's virtually impossible that banks don't have big mark-to-market losses on their balance sheet. We know that they all have big mark-to-market losses. Now, some of the bigger banks run those through their year-end stress test calculations. Some of the smaller banks don't, but we're getting more and more transparency to what banks' tier one capital looks like on a mark-to-market basis with their hedges. And we're not through to the other side of this. So nothing has changed in the banking sector from where we were 6 weeks ago, except we understand what happened at Silicon Valley Bank. We understand what happened at Signature Bank. We understand the mark-to-market losses in the available for sale and the hold-to-maturity buckets. I think all the banks are going to talk about the excess liquidity they have. I think many of the banks will talk about their insured to uninsured deposit ratio. I think they'll talk about their mark-to-market losses that are disclosed and non-disclosed in their hedging books and what the asset side of their balance sheet looks like. I think banks will go out of their way to give you more disclosure on what their portfolio looks like at this time, because I do think that is a good prophylactic. If you're trying to fight the knee-jerk reaction in Washington, which is just something bad happened, let's go regulate, show that the U.S. banking system as a whole is very, very well managed. It went into this whole scenario very well capitalized. And I think the bigger banks are going to go out of their way to show you how well capitalized they are.